credit risk. You will basically, in terms of mitigating them, you just require a very well-structured credit information sharing mechanism that can then be used by the credit provider to be able to mitigate the risk. When you're talking about market risk, again, is an issue of diversifying their portfolios, balancing their portfolios to ensure that they are able to manage that pretty well. Operational risks, on the other hand, I think they come from such ventures like, for example, you've got cyber attacks on the digital platforms, and in order to mitigate this, you just require a robust monitoring system and, of course, invest in the staff capacity to be able to manage and monitor the system to ensure that you seal any loopholes that may arise. When you're talking about liquidity risks, it's an issue of ensuring that you set minimum thresholds above which banks then should operate to ensure that they can be able to withstand any shocks that come into the market. Compliance and reputational risks, again, those ones are there to ensure that banks remain compliant to the regulations that have been stipulated or any requirements that have been put in by the regulatory framework to ensure that banks are always managing their risks on a distributed platform. Now, the current global trends, I think, have witnessed an adoption of emerging risk management techniques. And I'll not go into the details because this, I think Professor Ulrich in his presentation and even Dr. Masood mentioned about, and actually almost all the speakers have talked about stress testing. This is becoming almost like our bread and butter in the banking sector. We're talking about predictive analytics that now banks are beginning to use, not only to be able to manage their, businesses more efficiently and more effectively, but also there is the issue of using the same techniques to be able to identify and mitigate potential risks that may infuse into their banking operations. Of course, one of the other issues that has been brought up clearly was the issue of climate risk. And I think climate risk is affecting us in ways that we have not been able to assess before. It's filtering into all the various risks that you have mentioned. It's filtering into credit risk, it's filtering into the liquidity risk, it's filtering into operational risks. And therefore, we need to be alive to the fact that it's changing the way we have been managing our risks. The question that comes to mind is, do developing economies have the capacity to currently measure and mitigate, to support regulators to ensure that by absorbing them into your risk management profile? Now, in Kenya, for example, the Central Bank of Kenya came up with a guidance on climate-related risk management guidance for the commercial banks in Kenya. This was in 2021, and banks were meant to put the frameworks into place to become effective 2023. One of the requirements there is disclosure to the central bank. Now, what we did as the association was to support member banks to be able to align themselves to being able to report to the central bank as per their guidance. Now, what we did, therefore, we formed a committee, and with the guidelines from the task force on climate-related financial disclosure, we were then able to put in place a template that is currently being used and therefore helping banks to be able to be compliant to the requirements of the central bank. In fact, we launched this template during the Climate Week that was held in Nairobi last year. Now, recognizing the fact that the banking sector rates typically evolve, and with advancements in technology and in terms of the business models, the other players, including ourselves as associations, including the central bank, including the players, will also have to welcome new and innovative mechanisms of managing and mitigating these risks. We have talked about artificial intelligence, we have talked about machine learning. I think those are developments that are coming in, and banks are not any different from that. In order to be able to serve your customers more effectively and more efficiently and meet their needs, you have got to adapt onto these technologies. But they come with a risk. And you have to be cautious of the fact that the risks have got to be managed.
1 minute, can you conclude?
Now, if I can just quickly go into giving some examples, that I think the example that I can give is in Kenya, during the COVID, we saw some regulatory, should I call it regulatory innovation? There were a number of measures that were taken by both on the fiscal side and the monetary policy side. On the fiscal side, of course, tax measures and expenditure by the government to try to allay some of the challenges that the populace was meeting. But I think let's look a little bit more on the monetary policy side. Inflation was the risk. Currency pressures were coming in, and therefore the natural response from the monetary policy side would have been to tighten. But what did central bank do? On the contrary, they actually loosened. The central bank rate was taken down. The cash reserve ratio was taken down, releasing liquidity into the market, essentially to support the market to be able to, support the populace who needed some cash into their pockets. The other thing was IFRS 9. The measures that were taken by central bank was contrary to the expectation of IFRS 9 because they were effectively being allowed to, rather than impair the assets and therefore take provisions, they were actually being given some leeway to ride the customers through the pandemic and then subsequently then be able to do that. So for example, things like, for example, the repayment profiles, where banks were actually allowed to extend the repayment profiles of these customers to give them some breathing space to wade through the COVID-19 pandemic. So there were a number of innovative regulatory frameworks that were put in place to ensure that during challenging times we are also able to ride through. Chair, if you can just allow me to give just one example.
We are really out of time.
Just to illustrate a point.
Sure.
The fact that the regulation plays a significant role in terms of supporting innovation. And I'll give you an example. I'm picking the example of M-Pesa. M-Pesa came into operation in 2007. The regulatory framework that allows central bank to regulate a platform like M-Pesa was enacted in 2014. That was 7 years after M-Pesa came into operation. So for a whole 7 years, M-Pesa was operating without a proper regulatory framework. But that's a risk that the regulator took. And you can see the impact that M-Pesa has had, not only on the Kenyan economy, but regional economy for that matter. So I think there is a need sometimes for being innovative in terms of the regulatory approach to support innovation, even though we know that innovation sometimes introduces risks, which then you need to manage.
Okay.
I'll stop there, Chair.
Thank you very much. You talked about the issues of role of banking association for capacity building to support the